Hi, I'm Keley Peterson, founder and CEO of Willow Advisors. I often hear this comparison between index funds and mutual funds. And I've explained in another video about not confusing the structure or the vehicle by which you access a pool of stocks versus the way it's managed or the style of management. There are two different ways or two different styles of managing a portfolio of stocks. There are active managers and there are passive management. Now, an index fund is what you would consider passive management. That is where the ETF or the mutual fund will say, we're going to invest in the S&P 500. They don't have to think about what stocks are going to do well, which ones are going to do poorly. They're only going to invest in the S&P 500. The only time they make a change to that portfolio is when the people who determine which companies are in the S&P 500 actually change that grouping. For example, right now, they're considering Tesla to join the S&P 500. When that happens, there will be trading in Tesla to incorporate this new company into the index. That's called an index fund. The S&P 500, the Russell 1000, the Russell 2000. Those are all index funds. They're all passive. They don't make any decisions about good companies, bad companies. They just buy whatever is in the index. It's passive. Now, an active manager, on the other hand, they are actually going out into the market and say, they start with the 500 companies in the S&P 500. And they're going to look at them and they're going to do some research on them. And they're going to decide that this company over here, they think is going to do better than that other company that's similar to it. They'll make a decision to buy the company that they feel will do better based on the research they've done. That's active management. They are actively choosing companies they feel are going to be better. Now, actively managed portfolios tend to be a little bit more expensive than passively managed portfolios because you actually have that additional research that's needed. An index is just going to buy the index. But sometimes when there's a really inefficient market, say emerging markets or high yield bonds, you want someone who's actually going to be able to evaluate the companies that are going into the portfolio. One of the arguments for index funds is that over time, all the funds are going to perform like the index fund. And this is fundamentally true for the most part. So buy an index fund, and it's a lot less expensive because there's no research that goes into it. During times of high volatility or lots of uncertainty, research is showing that during those uncertain times, active managers actually perform better than passive managers or passive styles. There's no absolute one way or the other. A good combination is usually going to do better for you than adhering to one style or another. Investing can be complicated. There's lots of advice out there. It can be very confusing, the information you receive from different books, different people. An independent wealth advisor can help you find your way through the weeds to a portfolio that suits you and your circumstance and your tax situation and your goals. I'm Keley Peterson, founder and CEO of Willow Advisors. We can help you.